Hello everybody, welcome back to our channel Focus on Trading. Today's video is about candlestick patterns, a complete course of identifying candlestick patterns within the chart. During this video, you will master important and commonly used candlestick patterns. So don't move away and stay tuned and keep watching in order not to miss any part of this important course. And if you haven't subscribed to the channel since now, please subscribe and smash the bell notification on to get informed of new videos when being uploaded. Candlestick charts have been developed in 18th century by a Japanese rice trader. By Steve Nissen, the charts were introduced to the Western world. Candlestick charts techniques first published in 2001. A daily candlestick shows 4 price types for a day: open, high, low, and close. Every candle has 3 parts, one body and 2 wicks or shadows, upper and lower. Body indicates the open and close of the day, and the lower wick shows the low and the upper wick shows the high price of the day. The left candle is bearish and the right candle is bullish because the close of the candle located above the open price. Each candle which has long wicks or small body or combination of 2 and more than 2 candles show different status for the market. These different status have been developed as candlestick patterns that help us to read charts smartly. In common, candlestick patterns categorized in 3 combinations: 1 candle patterns, 2 candle patterns, and 3 candle patterns. 1 candle patterns. The first candlestick pattern which I want to talk about is Doji, which consists of 3 types. Number 1, dragonfly, 2, gravestone, and finally cross or natural doji, or sometimes it is called long-legged doji, which is very common. Now dragonfly. What is dragonfly doji? Dragonfly doji is a candlestick pattern which is described by the open, close, and high prices equal or very close to each other, while the low of the period is significantly lower than the former 3. The appearance of the dragonfly doji after a price advance warns of a potential price decline. And on the other hand, which is very usual and common, when it appears after a price decline warns the price possible rise. In both conditions, confirmation is needed. So the dragonfly doji is a trend reversal pattern. In the middle picture, as you can see, part 1 should be at least twice or more than part 2 in size. And the body should be very small in comparison with the wicks. This is a real example of dragonfly. As it's clear, we have a downtrend here. And after some red candles at the bottom, a dragonfly candle appears and brings this hope for the market that the price decline more likely is over and a rise in price is coming. There it is what it is. This trend reversal candle pushed the price to the up. On the opposite side of the dragonfly we have gravestone, which usually appears after a price rise on the top. And the same as the dragonfly is a trend reversal pattern and a sign of probable price decline after a green wave. These are 6 different shapes of gravestone. If there will be a body for gravestone, then it will be very tiny and very small in comparison with the upper wick. Besides, most of the time there is a lower wick for this candle, and the upper wick should be at least 2 times or more bigger than lower wick. In this example, clearly it can be seen that after the appearance of the gravestone at the end of a price rise, market pulls down and a decline in price can be seen. The last doji candle is cross or natural doji, and sometimes called long-legged if it has 2 long wicks. Cross doji appears in confused, consolidated or ranged market. Neither the buyers nor the sellers are on top. Both have equal power. The better thing in this kind of market is that stay away till the market makes its decision to go up or down. Theoretically, cross doji has no body because the open and close of the candle clustered on each other, or the close and open are too close together that we neglect and don't pay attention to that tiny body. In this chart, obviously you can see that by appearing cross doji on the chart, market get confused and consolidated and has no idea to go in which direction. Again, in this example, cross doji shows the ranged market, no matter what is the color of the tiny body of cross doji. What does matter are the next candles come after cross doji. Just through them we can determine the market direction. The next one candle pattern is hammer, which is a type of bullish reversal candlestick pattern that occurs at the bottom of the trend. The lower wick should be at least twice as big the candle body, and this pattern has no or just little upper shadow. No matter what is the color of candle body, but if green, it would be better. Sometimes the hammer forms invertedly. Again, it assumed as a bullish reversal candle, but it is better the hammer itself being formed, not inverted hammer. Let's together take a look at some real examples of hammer. In the first example, in this chart, we have lower highs and lower lows, but finally at the bottom of this downtrend, by forming this hammer, beautifully price breaks out the previous resistance levels one by one and pushes the price to the up. In the second example, there is a dip in price till here, where the hammer candle being formed, and from that point on the market reverses and the sellers take control of the market. So this nice positive wave take place in the market. And in the last example, the market is pulling down by these big red candles, and just by appearance of this hammer at the bottom, market pushes up. If you look at the body color of the candle, you can see that the body is red, and as I mentioned before, the body color doesn't matter, and as a result, regardless to the body color, price pushes up. The next one candle pattern is hanging man, exactly with the same definitions, rules and principles, just with this difference that appears at the end of an uptrend and supposed to be a bearish reversal candle. As soon as this candle being formed, we should be cautious and get ready to align our positions with the probable bearish market. Sometimes there is a small upper wick. If the body forms below and we have a long upper wick, therefore inverted hanging man we will have. Again, this candle acts the same as hanging man. Now together let's check some examples. Here we have an uptrend wave, till this hanging man candle being formed on the top at the end of these green candles. Just by the appearance of the candle, market reacts smartly and moves down. So make sure to comprehensively master the candlestick, because every single candle can have different meanings, and the smart traders in the market profit from this kind of candles. The next example is about inverted hanging man, which acts exactly the same as hanging man, pulling price to the down, which is clear on this chart. This is the inverted hanging man, appears at the end of an uptrend, upward price moving, and cause a decline in price. The next and last one candle pattern in our list is Marubozu, with a long red or green body with little to no upper or lower wicks. The candle shows the strong power of the traders according to its color. If red means that the sellers have absolute power against the buyers, and the control of the market is in the hands of the bears. And on the contrary side, when the Marubozu is green, bullish, the absolute power of the market belongs to the buyers, and bulls are on the top. In this picture, the left candle indicates a green and bullish Marubozu, and the right one shows the bearish Marubozu. Sometimes there is a small upper or lower wick. If the wick is near the close of the candle, Therefore, we call it Marubozu open, as it's clear in the picture. And if we have a small wick close to the open of the candle, then it is called Marubozu close. Pay attention that there is no need to memorize these names all. Just you need to be able to recognize these patterns properly on the chart. That's all. Usually, Marubozu candle occurs near the support resistance levels and cause the price pushing up or down with a high momentum. Now dive to some examples of Marubozu. This first example indicates two bullish Marubozu. The second bullish Marubozu has a longer lower wick, which lesser the power of the candle that eventually causes red long bearish Marubozu happens with just a small upper wick that keeps its power. But totally two bullish Marubozu candles have more power against one bearish Marubozu that cause the price move upward. In the next example, again we have two bullish Marubozu and one bearish Marubozu, which results in this big upward movement of the price. Now let me drop a line here. This is a resistance level, and as I mentioned before, the next bullish Marubozu occurs exactly on this level, and by passing through this level, a buy signal is being received from the market. Our entry trigger will be around here. In this last example, we have a support level around this zone. And as you can see, this support level being broken by this big bearish Marubozu. Usually, when Marubozu candle is too big with no or just very small and tiny wicks, more likely there will be no pullback to the previous broken areas. Two candle patterns. The Bullish Harami pattern. The Bullish Harami pattern is a reversal pattern appearing at the bottom of a downtrend. This pattern consists of a big bearish candle and a small bullish and a small bullish candle, which being engulfed by the former candle's body. Pay attention that the second candle's body should be bullish. Look at this example. The first candle is big and bearish, and the second candle is bullish and has been covered fully by the former candle's body, which together making a bullish Harami pattern that leads the price to move higher. An important point about Harami is that the second whole candle should be very small in comparison with the former candle's body. Another two candle pattern is Bearish Harami pattern, appears at the end of an uptrend and assumed to be as a trend reversal pattern. Same as Bullish Harami, this pattern also indicates two candles, a big bullish candle which followed by a small candle being engulfed by the former candle's body. In this example, we can see that how this pattern affects the price and pulls it to the downside. Another very important two candle pattern, which is visible more on the charts, is engulfing. Bearish and bullish engulfing. First, let's talk about bearish engulfing. This pattern consists of two candles, one bullish candle that followed and engulfed by the latter and second bearish candle. This is a bearish reversal pattern that appears at the end of an uptrend on the top. There are some principles about this pattern that should be considered. First, the upper and lower wicks of the former candle should be shorter than the upper and lower wicks of the latter candle, or in other words, should be engulfed wholly by the latter candle. Second, if the latter candle has wicks, then the former candle's body can be equal or less than the latter candle's body. Everything I said about bearish engulfing is clear in this example. This pattern appears at the end of an uptrend, and through this pattern, market pulls the price to the downside. The wicks of the former candle are shorter than the wicks of the latter candle. First candle being engulfed fully by the second candle, and eventually first candle's body is equal or less than the second candle's body. Bullish engulfing. Everything that was said about the bearish engulfing is also true about the bullish engulfing, just on the opposite side. This pattern is a bullish reversal pattern that forms at the bottom of a downtrend and signals the traders that there may be an uptrend price movement. All the principles and points that were referred for the bearish engulfing should also be considered for this pattern. In this example, we have a downtrend, and down here, a bullish engulfing has been formed. So, as a result, price pushing up beautifully by this bullish Marubozu. In the second example, again after some red candles, just by the appearance of the bullish engulfing pattern, market moves to the upside. If you look precisely, you can see that the first candle's body is equal to the ladder, not bigger than that, and the former candle's wicks are shorter. The last example again indicates a bullish engulfing. The ladder candle can be assumed as a Marubozu. Whenever the ladder candle shapes a Marubozu, then it empowers the pattern's validity more than before. Tweezers. First tweezer bottom. The last two candle pattern in this list is tweezers bottom and top. Probably it happens that some traders see no difference between engulfing and tweezers. That's normal because they have quick looks on the point. Now let me easily clear the difference. In the engulfing section, we said that the ladder candle engulfs the former wholly and only on the condition that the ladder candle has got wicks longer than the former candle, both candles' body can be equal. But the story is different about the tweezers. If the two candles have wicks, therefore the wicks should be at the same level, and if the candles have no wicks, then their body should be at the same level. I think now you got the point, and it's clear for you that what is the difference between these two patterns, tweezers and engulfing. But in general, if you ask me which pattern do I prefer more, my answer would be engulfing. But if the ladder candle of tweezers engulfs the former candle, then it all must be the same as engulfing. In tweezers bottom, that is a bullish reversal pattern, what matters more is that bottom of two candles, whether there will be wicks or no, should be at the same levels, and upper parts doesn't matter what it is, whatever it is. On this chart clearly you can see that the candle's wicks located at the same level. Moreover, since the second candle engulfs the former candle, the validity of the pattern goes up. Next example again shows that the wicks are at the same level. Now tweezers top. Tweezers top is a bearish reversal pattern. The upsides of two candles, whether wicks or body, should be at the same level, and the rest is the same as tweezers bottom. In this picture, we have two different types of tweezers top. In first pattern, the ladder candle has been engulfed wholly by the former candle. And in the second pattern, the two candles almost are in the same size. And finally, three candle patterns. There is just one pattern in this list, and it doesn't mean that we have just one type of three candle patterns. Only due to save time and give more attention and importance to one and two candle patterns, I focused more on them. Now shooting a star. Shooting a star is a three candle pattern which categorized into evening star and morning star patterns. The evening star, as it's clear from the name, comes with the darkness, means that is a bearish reversal pattern and cause a decline in price. You see the formation of this pattern in the picture. Sometimes there is a gap between the close of the first candle and lower body price of the second candle, whatever it is, open or close. If this state occurs, then the pattern has more validity. The middle or second candle of this pattern usually looks like a doji candle or always is a candle with a small body and short wicks. If you take this example, better we can understand the pattern. First candle always should be bullish. Second candle is not important, whether be bullish or bearish, but would be better if bearish. And the last candle should be bearish. Morning star. Morning star is a bullish reversal pattern, consists of 3 candles. First candle is bearish, second candle is allowed to be both bearish and bullish, and the last candle should be bullish. The gap between the first and second candle shows that the sellers have been exhausted and just want to get rid of their holdings. In this example, you can see the gap between the 2 first candles of the pattern, and very smartly the market after the appearance of this pattern moves upside. The last and final example indicates the morning star without any gap. Well, I think that's enough, and even till now, time of the video become too much. I tried to include the most important and commonly used patterns in this video. There are lots of other patterns that I didn't mention here. Please comment down if there is any other important pattern that missed in the video, and write which patterns you use more in your trades. And finally, don't forget to subscribe to the channel, please, to have our family bigger, and support me with your warm likes on this video. Thanks for watching, see you in the next video.